Howdy, Jacob here. Today we're looking at company Tapestry, number 35, 135 in our dividend yield screener. We're getting close to the end here. So 4.8 billion in revenue in 2014 up to 6.7 billion in 2023. We see a little bit of growth there. 8.2 billion on the market cap, 9.2 billion on enterprise value, a little bit of net debt for the company. Return on invested capital is low to mid double digits. So that's pretty impressive to see. The dividend yield is currently 3.9%, so just under the 4% we're looking for, but still a fairly substantial dividend. And it looks like they've been paying it out outside of COVID. They've been paying a pretty consistent dividend in the last 10 years. Great to see. Balance sheet, they have about $720 million, 740 million on cash and equivalents with their short-term investments, and then short-term and long-term debt is looking about 1.66 billion, and their 5-year average free cash flow got as low as 202 million in 2020, but still positive, and the year after pretty much negated it with a 1.23 billion dollars free cash flow. 5-year average maybe 700 million. Their dividend payout of 291 million is 307, looking at about 43%. So 40 to 50% on the dividend yield or dividend payout. They haven't really made any acquisitions since pre-COVID. And so a lot of their money has been going towards buying back shares that are hopefully cheap and then paying out a dividend. Okay. Okay. Interesting. So 700 million average 5-year average free cash flow is just over two years to pay off that long-term debt. And again, they also have 700 over 700 million in cash equivalents with short-term investments. The company's probably not going to be in danger of anything due to their balance sheet. And so, yeah, I think we can start making some assumptions here. I would say that they're already back to being above where they were pre-COVID. Pre-COVID, about 6 billion up to 6.6 billion. It looks like. So let's say 3% growth here. They do have good returns on invested capital, but the reinvestment is not super huge. But I will put just the tiniest bump in terminal P and price free cash flow, just in the case that they do have the opportunity to invest at these high rates if they choose to, even though historically they've really just bought back shares and paid a dividend and such. And paying down their buying back shares can also affect their return on invested capital. But margin side, they don't have too much debt, so I might do pretty close to average here. Let's say 10% net income, 11% free cash flow, and let's say they buy back 3% of shares. 3% of shares is going to be about 160 million. Their dividend payout of that much, and then maybe hopefully the rest will be reinvesting back into themselves. I would say they could probably grow this dividend a little bit. They haven't done it historically, but they, to me, can definitely afford it. And so, with their roughly 40% payout ratio, I would say that they could bump it up percent or so a year over the next 7 years, which gets us to a stock price that needs to fall 19% before you get a 15% return. Given these assumptions, I 3.9% dividend yield. It's pretty close to the 4%. If it falls a little bit more, then obviously you get that 4% if they don't change the actual dividend itself. And I mean, this might be a company I look further into and see whether these assumptions actually are appropriate or not. But for now, we just wait a little bit longer. But definitely one that I'd add to the dividend list just because I think this dividend's pretty safe. They got a healthy cash flow, payout ratio is pretty low, and their balance sheet looks pretty great with just over 2 years of 5-year average free cash flow for their long-term debt and a fair amount of cash on hand as well. So hopefully everyone enjoyed the video and has a great rest of the day. Thank you.